So welcome everyone to the most consequential Green Shoot session this year. For those that don't know, I'm Pat Patel from Elevandi, and the company that was set up by the MAS to foster an active dialogue between the public and private sectors to ultimately advance fintech in the digital economy. And we do this by connecting people and businesses, connecting ideas, and connecting insights. And today is a great example of what we do, as the key outcomes of this session is to provide clarity and advance the current thinking of crypto innovation and digital assets by bringing together the public and the private sectors. So we are absolutely honored to have MD Ravi Menon in the house to share MAS's position on cryptocurrencies, stablecoins, blockchain, tokenisation, and digital assets. And we're going to zone in on the risks and opportunities, shortcomings, and the potential. So innovation and responsibility is at the heart of digital assets. As the special bonus, we have an industry panel which will clarify and advance the thinking in the digital asset space. So it's quite fitting. We have an absolutely large audience with us today. We have around 100 people in the room from the public and private sectors. We have global media, plus we have thousands of people streaming in online from around the world. So without further ado, it's a pleasure to welcome one of the smartest minds in financial services, and he's very humble too, the Managing Director of the Monetary Authority of Singapore, Mr. Ravi Menon.
Thank you, Pat. Don't believe a word he said. Not only about me, but also about whether this is really the most consequential green shoots. Let me state at the outset, there are no new announcements, so some of the media you can switch off. No earth-shattering insights. We're just going to take this opportunity to repeat and clarify what we've said before, and I'll come to why in a while. So thank you all once again for joining us today, and let me start straight away with the elephant in the room. MAS seems to be sending mixed signals when it comes to crypto and digital assets. Okay, you're all too polite to say that, so I will say it. On the one hand, MAS is promoting Singapore as a fintech hub, partnering industry to explore distributed ledger technology and supporting innovation in digital asset use cases. MAS has said it wants to attract leading crypto players to Singapore. On the other hand, MAS has a stringent and lengthy licensing process for those who want to carry out crypto-related services in Singapore. And MAS has also been issuing strong warnings against retail investments in cryptocurrencies and has been taking increasingly stronger measures to restrict retail access to cryptocurrencies. So there have been expressions of confusion and concern by some observers. They point to apparent contradictions in MAS's stance. That although MAS has said that it is excited about the potential to build a crypto or tokenized economy, it also imposes a stringent regime. Some others have lamented that MAS has made a U-turn in its digital asset policies. They say that MAS was once making pro-crypto decisions, but was now being overly cautious and losing its appeal as a global crypto hub. Yet others see MAS as having struck the right balance, that the crypto winter is proving MAS's policies to be right. So what does MAS really want? Well, actually, we know what we want, but I think we need to do a better job of explaining it so that everyone else understands it too. Before I get to that, it's important to be clear about what we are talking about. Public and media attention has tended to focus on cryptocurrencies. But cryptocurrencies are just one part of the entire digital asset ecosystem. To understand the issues more sharply and what the benefits and risks are, and where the benefits and risks are, we need to be clear what the different components of this ecosystem are. So I can understand why there is confusion about cryptocurrencies, blockchains, and digital assets. And people use these terms interchangeably. The inherent complexity of this ecosystem has made it difficult even for MAS to get its messages across. And I can tell you, it's taken weeks and months to prepare for this. It's not easy to explain this. So today we'll try to do a better job of explaining the ecosystem and its different components, and what MAS is actively promoting, what MAS is discouraging, and what are the risks MAS is seeking to manage. My apologies if just the next couple of minutes, 1 to 2 minutes, sound like a tutorial, but it's important that we are clear about the concepts we are dealing with. A good place to start is with digital assets. A digital asset is anything of value whose ownership is represented in a digital or computerized form. Now, this is done through a process called tokenization, which involves using a software program to convert ownership rights over an asset into a digital token. Now, many items can potentially be tokenized. Financial assets like cash and bonds, real assets like artwork and property. Even intangible items can be tokenized, like carbon credits and computing resources. In other words, anything that has value, when tokenized, becomes a digital asset. Now, that is the concept we are most interested in. Now, digital assets are typically deployed then on distributed ledgers that record the ownership and transfer of ownership of these assets. Now, a blockchain is a particular kind of distributed ledger that organizes transaction records into blocks of data which are cryptographically linked together. Now, when deployed on distributed ledgers, digital assets can also be referred to as crypto assets. So now we get the terms. Now, it is this innovative combination of tokenization and distributed ledgers that offers transformative economic potential. It basically allows anything of value to be represented in digital form and to be stored and exchanged on a ledger that keeps an immutable record of all transactions. It is this crypto or digital asset ecosystem that supports use cases which can potentially facilitate more efficient transactions, enhance financial inclusion, and unlock economic value. This digital asset ecosystem is where MAS sees strong potential and is actively promoting. I've not said anything yet about cryptocurrencies, so let me come to that right now. Now, a cryptocurrency is the digital asset issued by the distributed ledger protocol. It is often referred to as the distributed ledger's native currency, used as a medium of exchange and store of value within the network. For example, to pay transaction fees or incentivize users to keep the network secure. But cryptocurrencies have taken a life of their own outside the distributed ledger. And this is the source of the crypto world's problems. Cryptocurrencies are actively traded, that's okay, and heavily speculated upon, that's not okay, with prices that have nothing to do with their underlying economic value related to their use on the distributed ledger. The extreme price volatility of cryptocurrencies rules them out as a viable form of money or investment asset. It is this speculation in cryptocurrencies that MAS strongly discourages and seeks to restrict. Let me now elaborate on Singapore's strategy to develop a digital asset ecosystem, as well as our regulatory approach to manage the risks of digital assets. Our vision is to build an innovative and responsible digital asset ecosystem in Singapore. And this is a core part of MAS's overall fintech agenda. And as everything else we do in fintech, innovation through industry collaboration is key to growing the digital asset ecosystem. Crypto technologies are promising, and there is great potential to improve financial services. And this is a common goal shared by MAS, the financial industry, and the fintech community. But the only way to find out what works is through experimentation and exploration, learning by doing. We are taking a four-pronged approach to building the digital asset ecosystem. First, to explore the potential of distributed ledger technology in promising use cases. Second, to support the tokenization of financial and real economy assets. Third, to enable digital currency connectivity. And fourth, anchor players with strong value propositions and risk management. The most promising use cases of digital assets in financial services are in cross-border payment and settlement, trade finance, and pre- and post-trade capital market activities. There are several promising developments, including in Singapore. In cross-border payments and settlements, wholesale settlement networks using distributed technologies, such as Partior, a joint venture between DBS, JP Morgan, and Temasek, are achieving reductions in settlement times from days to mere minutes. In trade finance, networks like Contour, which is formed by a group of trade banks, they're establishing common ledgers with traceability to automate document verification, enabling faster financing decisions and lower processing cost. In capital markets, MarketNode, it's a joint venture between SGX and Temasek, is leveraging distributed ledger technology to tokenize assets, which reduces the time needed to clear and settle securities transactions from days to just minutes. These are live examples. The concept of asset tokenization has transformative potential, not unlike securitization some 50 years ago. Tokenization basically enables the monetization of any tangible or intangible asset. It makes it easier to fractionalize an asset or split up its ownership. Tokenization allows the assets to be traded securely and seamlessly without the need for intermediaries. There are already interesting applications in Singapore of tokenization of both financial and real assets. UOB Bank has piloted the issuance of a 600 million Singapore dollar digital bond on MarketNode, MarketNode's servicing platform that facilitates a seamless workflow. OCBC Bank has partnered with Metaverse Green Exchange to develop green financing products using tokenized carbon credits to help companies offset their carbon emissions. MAS itself has launched an initiative called Project Guardian to explore the potential of tokenized real economy and financial assets. The first industry pilot, which is being led by DBS Bank, JP Morgan, SBI Group, and MarketNode, will explore the institutional trading of tokenized bonds and deposits to improve efficiency and liquidity in wholesale funding markets. A digital asset ecosystem needs a medium of exchange to facilitate transactions. The three popular candidates are stablecoins, cryptocurrencies, and central bank digital currencies, or CBDCs. How does MAS view each of them? What's our position on each of them? MAS regards cryptocurrencies as unsuitable for use as money and as highly hazardous for retail investors. Cryptocurrencies lack the three fundamental qualities of money: medium of exchange, store of value, unit of account. And as I mentioned earlier on, cryptocurrencies serve a useful function within a blockchain network to reward the participants who help to validate and maintain the record of transactions on the distributed ledger. But outside a blockchain network, cryptocurrencies do not serve a useful function, except, unfortunately, in many cases, as a vehicle for speculation. Since 2017, MAS has been issuing warnings about the substantial risks of investing in cryptocurrencies. Next, stablecoins. MAS sees good potential in stablecoins, provided they are securely backed by high-quality reserves and well-regulated. Stablecoins are basically tokens whose value is tied to another asset, usually a fiat currency, such as the US dollar. So they seek to combine the credibility that comes from their supposed stability with the benefits of tokenization. And that allows them to be used as payment instruments on distributed ledgers. Stablecoins are beginning to find acceptance outside of the crypto ecosystem. Some firms like MasterCard have integrated popular stablecoins into their payment services. Now, this can be a positive development if stablecoins can make payments cheaper, faster, and safer. But to reap the benefits of stablecoins, regulators must ensure that they are indeed stable. I will talk more about this later. I want to touch on CBDCs. MAS sees good potential in wholesale CBDCs, especially for cross-border payment and settlement. CBDCs are the direct liability of or payment instrument of a central bank. This means that holders of CBDCs have a direct claim on the central bank that has issued them, similar to how physical currency, our cash and notes, work. Wholesale CBDCs are restricted to use by financial institutions. They are akin to the balances which commercial banks place with the central bank today. Wholesale CBDCs on a distributed ledger have the potential to achieve what's called atomic settlement, or the exchange of two linked assets in real time. They have the potential, therefore, to radically transform cross-border payments, which today are, as every one of us knows, slow, expensive, and opaque. MAS does not see a compelling case for retail CBDCs in Singapore. So unlike wholesale CBDCs, retail CBDCs are issued to the general public. In fact, they are like the cash we carry with us, except they're in digital form. The case for a retail CBDC is not compelling for now, given well-functioning payment systems and broad financial inclusion. Retail electronic payment systems in Singapore are fast, efficient, and at zero cost, while a residual amount of cash remains in circulation and is unlikely to disappear. So we all have a fallback. Nevertheless, MAS is building the technology infrastructure that would permit issuance of retail CBDCs should conditions change. MAS has been actively experimenting with digital currency connectivity since 2016. On the international front, MAS is participating in Project Dunbar, which the Bank for International Settlements Innovation Hub is working on out of its Singapore center. The project is exploring a common multi-CBDC platform to enable cheaper, faster, and safer cross-border payments. Domestically, MAS is working with industry on Project Orchid to develop the infrastructure and technical competencies necessary to issue a digital Singapore dollar should there be a need to do so in future. Fourth strategy, MAS seeks to anchor in Singapore crypto players who can add value to our digital asset ecosystem and have strong risk management capabilities. A vibrant digital asset ecosystem will encompass a wide range of value-adding activities. Let me cite 3 examples. JP Morgan has established its digital assets capabilities in Singapore via its Onyx division, which has pioneered several DLT-based products and initiatives. And the offerings include round-the-clock real-time funds transfers with shorter settlement times and no intermediaries. Contour, which I mentioned earlier on, a global trade finance network of banks, corporates, and trade partners. Contour has established its Future of Finance Lab in Singapore, and it will conduct research to develop novel digitally native trade finance solutions. Nansen is a Singapore-based company that analyzes more than 100 million blockchain wallet addresses across the world. It provides insights on blockchain network activities and visibility on transacting parties, thereby helping to improve transparency in the digital asset ecosystem globally. Digital asset activities involving payment services must be licensed under the Payment Services Act. We recognize there is some frustration about MAS's licensing process. Some industry players have described it as a slow and tedious ordeal, others as a bugbear for the fast-moving space. Well, given how new the digital asset industry is, it has not been easy for industry players or for MAS. On MAS's side, we need to closely scrutinize license applicants' business models and technologies, and they're all bespoke and different, so that we can better understand the risks before we issue a license. On the part of the applicants, many of them are not familiar with managing the risks of facilitating illicit finance. So MAS engages the applicants very closely to assess their understanding of our rules and also their ability to meet our standards. This takes considerable amount of time, but it is necessary. MAS cannot compromise its due diligence process just to make it easy for digital asset players to get a license. And given the large number of applicants for licenses, we have been prioritizing those who demonstrate strong risk management capabilities and the ability to contribute to the growth of Singapore's fintech and digital asset ecosystem. Like all innovations, digital asset activities pose risks as well as benefits. When digital asset activities took off more than 5 years ago, regulators around the world, including MAS, assessed money laundering and terrorist financing risks as the key areas of concern. But with the rapid growth in scale and complexity of digital asset activities, other risks have surfaced. So regulators around the world, including MAS, are therefore stepping up their responses to these new risks. I will talk about 5 areas of risk in digital assets that MAS's regulatory approach is focusing on. First, to combat money laundering and terrorist financing risks. Second, to manage technology and cyber-related risks. Third, to safeguard against harm to retail investors. Fourth, to uphold the promise of stability in stablecoins. And 5, mitigate potential financial stability risks. The key risk that MAS regulation currently addresses is money laundering and terrorist financing. As users of cryptocurrencies operate through wallet addresses and pseudonyms, cryptocurrencies have made it easier to conduct illicit transactions. The online nature of these transactions adds to the risk. So in 2020, MAS imposed on providers of digital asset services the same anti-money laundering requirements that apply to other financial institutions like banks. And earlier this year, these rules were expanded to Singapore-incorporated entities who are providing digital asset services overseas. Singapore's requirements are consistent with international standards, namely those of the Financial Action Task Force, or FATF. Another risk that MAS has sought to address early on is technology and cyber-related risk. MAS was one of the earliest regulators to impose on digital asset players the same cyber hygiene standards and technology risk management principles that is expected of all other financial institutions. But technology and cyber risks are continually evolving. For example, coding bugs in smart contracts, compromise of digital token wallets or their encryption keys. So MAS is now reviewing measures to manage these and other technology and cyber-related risks, including further requirements to protect customers' digital assets and uplift system availability. And these steps are in line with what other jurisdictions are also considering, including in the EU and in Japan. MAS has since 2017 been reiterating the risks of trading in cryptocurrencies. Prices of cryptocurrencies are highly volatile, driven largely by speculation rather than any underlying economic fundamental. It is very risky for the public to put their monies in such cryptocurrencies, as the perceived valuation of these cryptocurrencies could plummet rapidly when sentiments shift. And we have seen this happen repeatedly. MAS has issued numerous advisories warning consumers that they could potentially lose all the monies that they put into cryptocurrencies. Just take, for example, Luna, the sister token of the so-called stablecoin Terra USD. Luna was at one point worth over $100, but tumbled to zero. MAS has taken early decisive steps to mitigate consumer harm. Since January this year, MAS has restricted digital asset players from promoting cryptocurrency services at public places. So this has led to the dismantling of Bitcoin ATMs and the removal of advertisements on cryptocurrencies in MRT stations. But despite these warnings and measures, surveys show that consumers are increasingly trading in cryptocurrencies. This appears to be a global phenomenon, not just in Singapore. Many consumers are still enticed by the prospect of sharp price increases in cryptocurrencies. They seem to be irrationally oblivious about the risks of cryptocurrency trading. Consumer-related risks have therefore gained the attention of regulators around the world. MAS is considering further measures to reduce consumer harm. Adding frictions to retail access to cryptocurrencies is an area we are contemplating. These may include customer suitability tests and restricting the use of leverage and credit facilities for cryptocurrency trading. But banning retail access to cryptocurrencies is not likely to work. The cryptocurrency world is borderless. With just a mobile phone, Singaporeans have access to any number of crypto exchanges in the world and can buy or sell any number of cryptocurrencies. The cryptocurrency market is also fraught with risk of market manipulation. These risks include cornering and wash trades, actions that mislead and deceive market participants about prices or trading volumes. You see this in stock exchanges, you're seeing this in crypto exchanges. They compound the inherent volatility and speculative nature of cryptocurrencies and can severely harm consumers. There is greater impetus now among global regulators to enhance regulations in this space. MAS will also do so. But safeguarding consumers from harm requires a multi-pronged approach, not just MAS regulation. First, global cooperation is vital to minimize regulatory arbitrage. Cryptocurrency transactions can be conducted from anywhere around the world. MAS is actively involved in international regulatory reviews to enhance market integrity and customer protection in the digital asset space. Second, the industry has an important role in co-creating sensible measures to protect consumer interests. MAS has been sharing its concerns with the industry and inviting views on possible measures to minimize harm to consumers. And we will publicly consult on the proposals by October this year. Third, consumers must take responsibility and exercise judgment and caution. No amount of MAS regulation or global cooperation or industry safeguards will protect consumers from losses if their cryptocurrency holdings lose value. Next risk, stablecoins. Stablecoins can realize their potential only if there is confidence in their ability to maintain a stable value. Many stablecoins lack the ability to uphold the promise of stability in their value. Some of the assets backing these stablecoins, such as commercial papers, are exposed to credit risk, market risk, and liquidity risks. There are currently no international standards on the quality of reserve assets backing stablecoins. So globally, regulators are looking to impose requirements such as secure reserve backing and timely redemption at par. MAS will propose for consultation a regulatory approach for stablecoins in Singapore also by October this year. Finally, financial stability risks. Financial stability risks from digital asset activities are currently low but bear close monitoring. As the digital asset ecosystem grows, it will be natural for linkages between the traditional banking system and digital assets to grow. There is risk of contagion to financial markets through exposures of financial institutions to digital assets whose values may plummet. So MAS is working closely with other regulators to design a prudential framework for banks' exposure to digital assets. This framework will provide banks with clarity on how to measure the risks of their digital asset exposures and maintain adequate capital to address these risks. And this will reduce the risk of spillovers into the traditional banking system. Let me conclude. Singapore wants to be a hub for innovative and responsible digital asset activities that enhance efficiency and create economic value. The development strategy and regulatory approach for digital assets that I have described go hand in hand towards achieving this. Innovation and regulation are not incapable of coexisting. We do not split the difference by being less stringent in our regulation or being less facilitative in our innovation. No. MAS's development strategy makes Singapore one of the most conducive and facilitative jurisdictions for digital assets. We work closely with the industry. At the same time, MAS's evolving regulatory approach makes Singapore one of the most comprehensive in managing the risks of digital assets and among the strictest in areas like discouraging retail investments in cryptocurrencies. So I hope this presentation has made clear that MAS's facilitative posture on digital asset activities and restrictive stance on cryptocurrency speculation are not contradictory. It is in fact a synergistic and holistic approach to develop Singapore as an innovative and responsible global digital asset hub. So with that, I've come to the end of my remarks. I hope this has made matters clearer. I just thought I should add, there are lots of people from the media tuning in. There's a little discussion among my colleagues as to what the headlines will be. And I sympathize with the media because it is not easy to convey the complexities of the issues that I've just laid out, the benefits, the costs, the different aspects, the difference between cryptocurrencies and digital assets, and what we're talking about, what we're trying to achieve. But I leave it in your good hands. The title of the speech itself may be a headline, hint, hint, but it's really up to you. Really up to you, and we look forward to working closely with you. And we do need to explain this repeatedly to the public and to the industry so that we can get to where we want, harnessing the benefits and minimizing the risks. Thank you very much.
So thank you, MD, for clarifying and sharing MES's position. I think it certainly was a Finance 101 tutorial as well as a tutorial on digital assets. I think at this point, I'd like to thank the thousands of people that have streamed in, have taken the time from around the world, and have a great week ahead. Clearly keep it real and keep building is the message from today.